The signs are everywhere. Central banks are moving gold at a pace we haven't seen in decades. The BRICS nations just accumulated another 20 tons in a single quarter. That's $2.5 billion worth of physical metal, quietly purchased while the financial media talks about everything except what's actually happening in the vaults. And here's what nobody's telling you. This isn't random. This is coordinated. This is preparation. Let me show you what's really going on behind the scenes, because what's about to unfold will reshape the entire global financial system. And if you're not positioned correctly, you're going to watch your purchasing power evaporate in real time. Think about this for a second. When was the last time you saw central banks around the world agree on anything? They can't agree on interest rates. They can't agree on inflation targets. They can't even agree on what inflation actually means anymore. But there's one thing they're all doing in perfect unison: buying gold. Massive amounts of it. The People's Bank of China has been on a buying spree that would make a Black Friday shopper blush. Month after month, they're adding to their reserves. Russia's central bank? Same story. Turkey, India, Poland, Singapore, the list goes on. These aren't small purchases either. We're talking about hundreds of tons being moved from Western vaults to Eastern strongholds. Now, why would they do this? Why would sophisticated financial institutions, run by some of the smartest economists and strategists on the planet, suddenly decide that a barbarous relic is worth stockpiling? The answer is simple, and it's terrifying. They know something is coming. Let's talk about what a monetary reset actually means, because this isn't some conspiracy theory cooked up in a basement. This is monetary history repeating itself, and the pattern is crystal clear once you know what to look for. Every 40 to 50 years, the global monetary system hits a breaking point. The math stops working. The debt becomes unpayable. The currency loses credibility. And then, reset. It happened in 1971 when Nixon closed the gold window. It happened in 1944 with Bretton Woods. It happened in 1922 with the Genoa Conference. Go back further, and you'll see the same pattern playing out again and again throughout history. We're now 54 years past the Nixon shock. The system that was supposed to be temporary has been held together with duct tape and central bank promises for over half a century, and it's finally breaking down. Here's what most people don't understand about the current system. When Nixon severed the dollar's link to gold, he didn't just change monetary policy. He fundamentally altered the nature of money itself. For the first time in human history, the world's reserve currency was backed by nothing except the full faith and credit of a government. Not gold, not silver, not anything tangible, just trust. And for a while, that worked. The United States was the dominant economic and military power. The dollar was as good as gold because everyone believed it was. But belief is a fragile thing. And right now, that belief is cracking. Look at what's happening with the BRICS nations: Brazil, Russia, India, China, South Africa. And now they're expanding. Saudi Arabia is interested. The UAE is interested. Egypt, Ethiopia, Iran. Over 40 countries have expressed interest in joining or working with this bloc. And what are they all talking about? Creating an alternative to the dollar-dominated system. They're not just talking about it anymore. They're building it. There are reports of a gold-backed digital currency being developed. A unit that would be used for international trade settlement, bypassing the dollar entirely. The pilot program has already been discussed at the highest levels. Now, imagine you're a central banker in one of these countries. You've watched the United States weaponize the dollar. You've seen sanctions cut countries off from the SWIFT system. You've watched the Federal Reserve print trillions of dollars, diluting the value of your reserves. What would you do? You'd buy gold, lots of it. Because gold can't be sanctioned. Gold can't be printed. Gold can't be frozen in a bank account somewhere. Gold is the ultimate neutral reserve asset, and it's exactly what you need if you're planning to launch a new monetary system. The numbers tell the story. Global central bank gold purchases hit a record high recently. Not just high, record-breaking. We're talking about over 1,000 tons purchased in a single year. That's more than the annual production of every gold mine in South Africa combined. That's more than the entire gold reserves of Switzerland. And here's the kicker. Those are just the official numbers. The actual purchases are likely much higher, because not every central bank reports their gold transactions. China, for example, went years without reporting any gold purchases, then suddenly announced they'd been buying the whole time. How much gold do they really have? Nobody knows for sure. but analysts estimate it could be double or triple their official figures. Why the secrecy? Because if everyone knew how much gold was really being accumulated, the price would explode. And these central banks want to accumulate as much as possible before the reset happens. They're front-running the biggest monetary shift in modern history. Let's talk about what this means for the dollar. Right now, the dollar's dominance is based on a few key factors. It's the currency used for international trade, especially oil. It's the currency central banks hold in their reserves. It's the currency of choice for global debt markets. But all three of these pillars are being systematically dismantled. Saudi Arabia, the cornerstone of the petrodollar system, is now accepting yuan for oil sales to China. That's not a small thing. That's a direct challenge to 50 years of dollar hegemony. When oil is no longer exclusively priced in dollars, the demand for dollars drops. When demand drops, value drops. It's basic economics. Then you have the reserve currency issue. For decades, central banks held 60–70% of their reserves in dollars. That number is now below 60% and falling. They're diversifying into euros, yen, yuan, and gold, especially gold. Because gold doesn't have counterparty risk. Gold doesn't depend on any government's fiscal responsibility. Gold just is. The debt market is even more concerning. The United States has over $36 trillion in national debt. That's trillion with a T. The interest payments alone are approaching $1 trillion per year. Think about that. We're paying nearly $1 trillion just in interest, not even touching the principal. That's more than we spend on defense. That's more than we spend on most government programs. How do you pay that back? You can't. Not with real money, anyway. The only way out is to inflate it away. Print more dollars, make each dollar worth less, and suddenly that debt becomes more manageable in nominal terms. But here's the problem. Everyone knows this is the plan. And when everyone knows you're going to debase your currency, they start looking for alternatives. Enter gold. Enter alternative currencies. Enter the monetary reset. Now, I want to take a quick aside here because this is important. If you're sitting on $100,000 or more in retirement accounts, you need to understand how gold IRAs work. I've put together a free guide that covers exactly how to get physical gold into your retirement account without triggering tax penalties. It's in the description below. This isn't about speculation. This is about protecting what you've already built. Worth checking out if that's relevant to your situation. All right, back to the reset. Let's talk about what actually happens when a monetary system resets. Because this isn't theoretical. We have historical examples, and they're not pretty for people who aren't prepared. When Bretton Woods collapsed in 1971, gold went from $35 an ounce to over $800 by 1980. That's a 2,200% increase in less than a decade. People who owned gold preserved their wealth. People who held cash and bonds watched their purchasing power evaporate as inflation hit double digits. But here's what's different this time. The scale is so much larger. In 1971, global debt was measured in billions. Now it's measured in hundreds of trillions. The derivatives market alone is estimated at over $600 trillion. That's not a typo. $600 trillion in notional value, all built on a foundation of fiat currency and fractional reserve banking. When this system resets, it's not going to be a gentle transition. It's going to be chaotic. There will be winners and losers, and the difference between the two will come down to one thing: preparation. The smart money is already moving. Look at what the ultra-wealthy are doing. They're buying farmland. They're buying real estate. They're buying precious metals. They're diversifying out of paper assets and into hard assets. Why? Because they understand that when the reset comes, paper promises won't be worth the paper they're printed on. Let me give you a specific example. There's a reason why billionaires are suddenly interested in agricultural land. Bill Gates is now the largest private farmland owner in America. Why would a tech billionaire want farmland? Because land produces food, and food has intrinsic value. You can't eat dollars. You can't eat bonds. But you can eat food grown on land you own. The same logic applies to gold and silver. These metals have been money for 5,000 years. Every fiat currency in history has eventually failed. Every single one. The dollar, the euro, the yen. They're all fiat currencies. They're all backed by nothing but government promises, and history shows us exactly how that story ends. But gold? Gold has never gone to zero. Silver has never gone to zero. They've been stores of value through empires rising and falling, through wars and plagues, Through every financial crisis humanity has ever faced, that's not a coincidence. That's the market telling you something fundamental about the nature of money. Now let's talk about the mechanics of how this reset might actually unfold. There are a few different scenarios, and understanding them is crucial to positioning yourself correctly. Scenario 1. The BRICS nations launch their gold-backed currency, and it gains traction as an alternative to the dollar for international trade. Initially, this might seem like a minor development, but as more countries adopt it, the demand for dollars decreases. The Federal Reserve, in an attempt to maintain dollar dominance, might raise interest rates aggressively. This would strengthen the dollar in the short term, but would also crash the economy by making debt service impossible for businesses and consumers. Alternatively, the Fed could keep rates low and print more money to service the debt. This would weaken the dollar and accelerate inflation. Either way, the purchasing power of dollar-denominated assets declines. Gold, priced in dollars, would soar as investors flee to safety. Scenario 2. A major financial crisis triggers a loss of confidence in the banking system. We saw a preview of this with the regional bank failures recently. Silicon Valley Bank, Signature Bank, First Republic. These weren't small institutions, and they collapsed in a matter of days. Now imagine that happening on a larger scale. Imagine a major money center bank facing a liquidity crisis. The government would have to step in with bailouts, which means printing more money, which means more inflation, which means... You see where this is going. Scenario 3. Geopolitical tensions escalate to the point where the dollar's role as the global reserve currency is actively challenged. This could happen through a major conflict, through economic sanctions that backfire, or through a coordinated effort by multiple nations to establish an alternative system. In this scenario, the transition away from the dollar could be rapid and disorderly. Any of these scenarios, or a combination of them, could trigger the reset. And here's the thing. You don't need to predict exactly which scenario will play out. You just need to be positioned for the outcome, which is the same regardless of the path. A massive revaluation of hard assets relative to paper assets. Let's talk about gold revaluation specifically, because this is where things get really interesting. Right now, gold is trading around $2,000 to $2,100 per ounce. That seems like a lot compared to historical prices. But when you adjust for inflation, when you look at the money supply, when you consider the debt levels, gold is actually undervalued. Here's a thought experiment. If the United States wanted to back its currency with gold at current reserve levels, what would the price of gold need to be? The U.S. officially holds about 100 tons of gold. The M2 money supply is over $21 trillion. Do the math. To back even a fraction of the money supply with gold, the price would need to be multiples higher than it is today. Some analysts put the fair value of gold at $10,000 per ounce. Others say $20,000. Some even argue for $50,000 or higher. These aren't random numbers. They're based on historical ratios between gold and money supply, gold and GDP, gold and debt levels. And all of them point to the same conclusion. Gold is significantly undervalued at current prices. But here's what most people miss. The revaluation won't happen gradually. It will happen suddenly. One day, gold will be $2,000. The next day, after some announcement or crisis, it could be $5,000. Then $10,000. The move will be swift and violent, and if you're not already positioned, you'll miss it. We've seen this pattern before. In 1979, gold was around $200. By January 1980, it hit $850. That's a 325% increase in less than a year. People who waited for a pullback to buy missed the entire move. People who were already holding gold made fortunes. The same thing is about to happen again, but on a much larger scale. Because the imbalances in the system are much larger. The debt is much larger. The money printing is much larger. Everything is larger, which means the correction will be larger too. Now let's address the elephant in the room. What about the stock market? What about real estate? What about other investments? Here's the truth. In a monetary reset, everything gets repriced. Stocks might go up in nominal terms, but down in real terms. A stock that doubles in price sounds great until you realize that gold tripled and your purchasing power actually decreased. Real estate is similar. Property values might rise in dollar terms, but if gold is rising faster, you're losing ground. Plus, real estate has carrying costs, property taxes, maintenance, insurance. Gold has none of that. You buy it, you store it, and it sits there maintaining its value through any crisis. This is why central banks hold gold, not stocks. This is why the ultra-wealthy are accumulating gold, not just paper assets. They understand that in a reset, you want to hold the asset that will be revalued upward, not the assets that will be devalued. Let me tell you a story that illustrates this perfectly. In Weimar Germany, during the hyperinflation of the 1920s, there were two neighbors. One was a successful businessman who kept his wealth in marks, in bank accounts and bonds. The other was a modest jeweler who kept his wealth in gold and silver. When the hyperinflation hit, the businessman's fortune evaporated. His millions of marks couldn't buy a loaf of bread. The jeweler, meanwhile, was able to trade his gold for food, for property, for anything he needed. Same country, same crisis. Completely different outcomes based on one decision: what form of wealth to hold. That story is about to repeat itself on a global scale. The question is, which neighbor are you going to be? Here's another angle most people don't consider. The supply and demand dynamics of gold are fundamentally changing. Gold mining production has been flat or declining for years. The easy gold has been found. New discoveries are rare. Production costs are rising. Meanwhile, demand is exploding. Central banks are buying. Retail investors are buying. Institutions are buying. The math doesn't work. When demand exceeds supply, price has to rise. It's not a matter of if, but when and by how much. And then there's the paper gold market. This is crucial to understand. Most gold trading happens on paper. Futures contracts, ETFs, unallocated accounts. For every ounce of physical gold, there are estimated to be 100 to 200 ounces of paper claims on that gold. This works fine as long as everyone doesn't ask for physical delivery at the same time. But what happens when they do? We've already seen cracks in this system. During the pandemic, there were massive dislocations between paper gold prices and physical gold prices. Premiums on physical coins and bars skyrocketed. Dealers ran out of inventory. The paper market said gold was $1,700, but try buying a physical ounce for that price. You couldn't. The real price was much higher. In a reset scenario, this disconnect will become extreme. Paper gold might trade at one price, but physical gold will trade at a massive premium. And if you're holding paper gold, good luck converting it to physical when everyone else is trying to do the same thing. The system will freeze up. Delivery will be delayed or denied. You'll be left holding a paper promise while the real metal is locked away in vaults. This is why informed investors are buying physical gold and silver, not paper proxies. They want the metal in their possession, under their control. Because when the reset happens, possession will be everything. Let's talk about timing, because I know that's what everyone wants to know. When is this going to happen? The honest answer is, nobody knows the exact date. But we can look at the indicators, and they're all flashing red. The yield curve has been inverted. That's historically been a reliable predictor of recessions. The Fed's balance sheet is bloated beyond anything we've seen before. Inflation is proving to be stickier than expected. The banking system is fragile. Geopolitical tensions are escalating. The BRICS nations are accelerating their de-dollarization efforts. Every indicator that preceded previous monetary crises is present right now. Some analysts think we have a few years. Others think we have months. But here's what everyone agrees on. The window for preparation is closing. Once the reset begins, it will be too late to position yourself. The premiums on physical metals will explode. Availability will dry up. Capital controls might be implemented. You'll be stuck in whatever position you're in when the music stops. Think of it like musical chairs. Right now, the music is still playing. People are dancing around, not too worried. But there are fewer chairs than players, and when the music stops, there's going to be a mad scramble. The people who are already sitting down, who already own physical gold and silver, will be fine. Everyone else will be left standing. Here's something else to consider. Governments know this is coming too, and they're preparing. Not to help you, but to help themselves. We've already seen proposals for wealth taxes, for capital controls, for restrictions on gold ownership. In times of crisis, governments always look for scapegoats and for ways to confiscate wealth. It happened in 1933 when FDR confiscated gold from American citizens. It happened in Cyprus when they raided bank accounts. It happened in Argentina, in Greece, in Venezuela. It will happen again. The best defense is to own assets that are hard to confiscate and easy to hide. Physical gold and silver, stored securely, fit that description perfectly. They're portable, divisible, and universally recognized as valuable. In a crisis, they're the ultimate insurance policy. Now, I want to address a common objection. But gold doesn't pay interest or dividends. Why would I hold it? This misses the entire point. Gold isn't an investment in the traditional sense. It's insurance. It's a store of value. It's a hedge against the debasement of fiat currency. You don't hold gold to get rich. You hold gold to stay rich. Think about it this way. If your house burns down, you don't complain that your fire insurance didn't pay dividends. You're grateful you had it. Gold is the same thing. It's insurance against monetary fire, and right now, the house is filling with smoke. The wealthy understand this intuitively. That's why they allocate a portion of their portfolio to gold regardless of market conditions. It's not about timing the market. It's about having a permanent allocation to the one asset that has survived every financial crisis in history. Let me give you some specific numbers to think about. If you have a $500,000 portfolio and you allocate just 10% to physical gold, that's $50,000. If gold triples in a reset scenario, that $50,000 becomes $150,000. That $100,000 gain could offset losses in other parts of your portfolio. It could be the difference between retiring comfortably and having to work another decade. But here's the key. You need to own the physical metal, not paper proxies, not mining stocks, not ETFs, not futures contracts, physical gold and silver that you can hold in your hand or store in a secure vault under your control. The reset is coming. The signs are everywhere. Central banks are preparing. The wealthy are preparing. Foreign governments are preparing. The only question is, are you preparing? This isn't about fear. This is about facing reality. The current monetary system is unsustainable. The math doesn't work. The debt can't be repaid. The only way out is through a reset, and that reset will transfer wealth from those who are unprepared to those who are prepared. You have a choice to make. You can ignore the warning signs and hope everything works out. Or you can take action now while there's still time. You can position yourself to not just survive the reset, but to thrive during it. History is watching. Your future self is watching. What are you going to do?